Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at MP Materials.
If you find our talks useful, please consider subscribe, like, and comment underneath. Now, let's just jump right into it.
Sounds good.
So imagine you're trying to build a modern military, but your biggest global rival controls like 90% of the one ingredient you absolutely need.
Right, the ingredient that, makes your missiles fly straight.
Exactly. Your radar systems, your fighter jets, all of it. And this isn't some hypothetical scenario we're just making up. It is the literal reality of the global rare earth metals market right now.
It really is, and that's exactly why we're looking at MP Materials today. Because to understand why they're suddenly all over institutional investment conversations, you have to look past just mining. You have to focus on this massive geopolitical vulnerability.
Yeah, because it's essentially the only gas station on a very long, very critical desert highway for U.S. manufacturing.
That is the perfect way to put it. And the stakes are incredibly high when you look at the macro picture. I mean, we're looking at a domestic company that just delivered an absolute blowout in their Q4 2025 earnings.
Oh, yeah, the numbers were crazy.
Insane, right. The analyst consensus had their adjusted earnings per share estimated at like 2 cents, and MP Materials came in at 9 cents.
Wow, a 9-cent beat against a 2-cent estimate is massive.
It's a huge beat, and it's really crucial to understand how they actually pulled that off, in an inflationary environment where heavy industrial companies are just getting their margins crushed.
Oh, right, because of rising equipment and labor costs.
Exactly. But MT Materials showed phenomenal operational leverage. They achieved record production levels throughout 2025.
So they're spreading those fixed costs over a much larger volume of product, basically.
Exactly. When you can scale your production that efficiently without letting your expenses spiral out of control, well, your profit margins just expand exponentially.
And what they're actually pulling out of the ground makes this even more fascinating. Because, I mean, we aren't talking about copper or iron here. The focus is specifically on materials used to make neodymium iron boron magnets.
Right. Which sounds super technical.
It does. And if you're listening and you're not a material scientist, you're probably wondering why a magnet is driving billions of dollars in market capitalization.
Well, these specific magnets generate incredibly intense magnetic fields in very small, lightweight packages.
Which is exactly what you need for an electric vehicle. You really can't afford to have this massive, heavy motor weighing down the car and draining the battery.
No, you need a compact motor that produces massive torque. And neodymium magnets are the invisible mechanism that actually makes that possible.
You literally cannot build an efficient modern EV without them.
You can't. And the exact same physical properties apply to advanced defense applications too. Guidance systems, radar components, targeting lasers, they all require precise, lightweight, and super powerful magnetic components.
So the demand side of this equation is essentially locked in for the next decade.
Oh, easily. The transition to EVs and the modernization of military hardware are structural global trends. But the supply side is where this bottleneck gets genuinely terrifying for the U.S. government.
Right, because China currently dominates 90% of global rare earth production.
90%. And they've spent decades building this state-sponsored monopoly. Not just in mining the ore, but in the highly complex chemical processes required to actually separate and refine it.
Which puts the U.S. in an incredibly compromised position. Like, if diplomatic relations sour, or if China decides to just prioritize its own domestic EV manufacturers by restricting exports, U.S. production lines would grind to an absolute halt.
They would, and there's historical precedent for this. We have seen export quotas used as geopolitical leverage before.
So this is where MP Materials enters the picture as a strategic asset.
Right.
Because they are the sole integrated rare earth producer in the United States.
The only one. If you are an American auto manufacturer or a defense contractor trying to secure your supply chain, MP Materials is essentially your only domestic alternative.
And that creates an economic moat that is incredibly difficult for any new competitor to bridge. I mean, simply because finding and permitting a new rare earth mine in North America takes over a decade.
Yeah, it's a massive advantage. Having that geographic monopoly on the raw material is huge, but digging rocks out of the ground is still a low-margin commodity business at the end of the day.
Right.
The real thesis behind MP Materials right now is their transition. They're executing what they call a mine-to-magnet strategy.
Wait, so instead of just extracting the raw ore and shipping it overseas to be processed into finished magnets, They're doing it all.
Yes. They are building the infrastructure to do the chemical separation, the refining, and the final high-tech manufacturing entirely in-house, right here in the U.S.
They're capturing the entire value chain. That's a huge shift. But I do want to dig into the mechanics of that transition.
Go for it.
Because moving from a pure extraction model to an advanced manufacturing model requires an entirely different set of engineering disciplines.
Oh, completely.
You go from moving dirt with heavy machinery to operating complex chemical processing facilities to, precisely forging magnetic alloys. It sounds incredibly expensive and risky. How are they paying for this without drowning in debt?
Well, the institutional validation they're getting for this strategy is frankly staggering. General Motors didn't just sign a purchase agreement, they provided MP Materials with a $50 million prepayment to help support this manufacturing expansion.
$50 million up front. That is a massive vote of confidence.
It is, and the mechanism of a prepayment is what investors really need to pay attention to here.
Because normally, if a company wants to build a new factory, they have to issue more stock, which dilutes existing shareholders.
Right.
Or they take on high-interest debt.
Exactly, which damages their balance sheet. But GM providing $50 million up front is non-dilutive financing. GM is looking at their own vulnerability. They know they need millions of these magnets to hit their EV production targets.
So they're deciding it's cheaper and safer to literally finance their supplier's factory than risk a supply chain collapse.
Precisely. And that institutional backing extends to the tech sector, too. Apple has also signed on as a customer for these domestic rare earth magnets.
Oh, wow. Apple is notoriously rigorous about how they manage their supply chain. They require absolute precision, reliability, and massive scale.
Exactly. If Apple is integrating MP materials into their manufacturing ecosystem, it serves as a seal of approval for the rest of the market.
Plus, Apple has public mandates to aggressively secure reliable, non-China supply chains for their critical components.
Right, which creates incredibly high switching costs. Once a company like Apple or GM spends the time and money to engineer a domestic magnet into their product line and validate the quality, they are not going to arbitrarily pivot back.
Right, they aren't going to risk a vulnerable overseas supplier just to save a few pennies per unit. But let's look at the risk profile again for a second. Moving downstream into high-tech manufacturing is just incredibly capital intensive.
Very. We're talking about billions of dollars in specialized equipment and highly compensated engineering talent.
So even with GM's $50 million, I have to question how a mining company manages to fund this kind of massive strategic pivot without leveraging their balance sheet to the brink of bankruptcy.
And that is normally the Achilles heel for most resource companies attempting vertical integration. But MP Materials has fundamentally altered their risk profile through government intervention.
Government intervention?
Yes. The U.S. Department of Defense recognizes that having zero domestic magnet manufacturing capacity is an unacceptable national security vulnerability.
Ah, so the Pentagon has stepped in with significant financing.
Exactly. They are providing financing to help fund MP's capital expenditures. The government is directly subsidizing the creation of this supply chain.
Okay, it makes sense that the Pentagon would want a domestic supplier. But government grants only go so far when you're dealing with volatile commodity markets.
That's true.
Like if global rare earth prices crash tomorrow, does MP Materials just sit on an expensive new factory that operates at a loss? Doesn't relying on a government safety net suggest the pure open market economics might be too fragile?
That's a fair question, but this is where we uncover the most unique structural advantage in their entire business model. MP Materials secured a Pentagon-backed price floor of $110 per kilogram for their output.
Wait, really? A guaranteed price floor?
Yes. To understand how unprecedented this is, you have to view it as a literal put option provided by the U.S. military.
That is wild, because in a normal commodities market, your biggest risk is cyclical pricing. If global prices drop below your cost of production, you just bleed cash.
Exactly. But with this agreement, if foreign competitors artificially flood the market and drive the global price of rare earths down to, say, $60 a kilogram, the Pentagon ensures MP Materials still receives $110 per kilogram.
You really have to ask yourself, as an investor, why the government would agree to artificially prop up a company's pricing like that. What happens if political winds shift?
Well, if we look at the mechanics of the rare earth market, we realize it's not a free market to begin with. We're dealing with a heavily distorted ecosystem.
Because of foreign state-sponsored monopolies.
Right. Historically, they have used predatory pricing tactics. They intentionally dump massive amounts of cheap supply onto the global market, specifically to bankrupt emerging competitors in North America and Europe.
And then once the new competitor goes bankrupt, the monopoly restricts supply and jacks the prices back up.
Exactly. The Pentagon price floor is designed to neutralize that exact tactic. It isn't propping up an inefficient business. It's providing a shield against artificial market manipulation.
That distinction is so critical. It guarantees that MP Materials can survive a predatory pricing war long enough to reach scale. The floor is a defensive mechanism against manipulation, not a crutch for bad operations.
Exactly. So we have established a robust fundamental picture here. They crush their Q4 earnings. They have non-dilutive capital from GM, and they have an absolute floor under their revenue, courtesy of the Department of Defense.
Right. So if you're listening to this and looking at the fundamentals, you might expect the stock chart to just be a straight line up. But if we look at the actual trading mechanics, the price action tells a much more complicated story.
It really does. The technical setup requires careful unpacking because the volatility has been extreme.
Yeah, over a recent one-year period, this stock went on a totally euphoric run, delivering a total return between 108% and 138%.
Momentum investors piled in as the geopolitical narrative caught fire. But today, shares are trading in a range between $49.49 to $58.23.
Which is a decline of over 50% from its 52-week high.
Right. And if you are an investor looking at your portfolio, seeing a 50% haircut is usually a trigger to, well, panic. It looks like the thesis is broken.
But we have to look at how technical analysts interpret this kind of drawdown following a triple-digit run. Think of it like a runner. The stock sprinted a marathon to get those 130% returns, and now is taking a necessary water break.
Exactly, rather than collapsing from exhaustion. Think of market momentum like a highly compressed physical spring. During that massive run, the spring stretched to its absolute limit. All the buyers rushed in at once, driving the price up to unsustainable levels based on pure hype.
And what we're seeing now with this 50% pullback is the tension releasing. Early investors who bought at the bottom are taking their profits, which creates selling pressure.
The critical metric here is how the stock is behaving during the sell-off. Technical analysts are looking at key moving averages, specifically the 50, 100, and 200 daily moving averages.
Which act as psychological support levels for institutional buyers.
Exactly. And right now, MP Materials is finding its footing right along those long-term averages. Momentum is shifting from euphoric to consolidatory.
So it's creating a healthy reset of the Relative Strength Index, the RSI. It went from being massively overbought to finding a healthy equilibrium.
And most importantly, we are not seeing a total collapse in trading volume during this downward move.
Which tells us, what about the institutional mindset? If volume isn't collapsing on a 50% drop, what is the smart money doing?
It indicates that large institutional investors are not abandoning their positions in a panic. They are absorbing the selling pressure from the short-term retail traders who are taking profit.
So the ownership of the stock is transferring from weak hands looking for a quick trade to strong hands building long-term positions.
Exactly. The market is digesting the massive gains and waiting for the fundamentals to catch up to the valuation before initiating the next leg up.
And it seems like the broader macroeconomic environment is actually aligning perfectly to support that next leg up.
It really is. Beyond the company's internal operations, the external tailwinds are gathering strength. We are seeing a significant easing in energy prices right now.
Right, and if you think about the mechanics of mining and chemical refining, it requires an astronomical amount of electricity and diesel fuel.
Exactly. When energy prices drop, MP Materials sees an immediate and direct expansion in their profit margins without having to change anything about their operations.
But the causal chain of the macro environment goes even deeper than that, right?
Oh, definitely. We have to factor in the recent U.S.-Iran ceasefire developments. By stabilizing a major geopolitical flashpoint, we are seeing a reduction in global risk sentiment.
Which leads to a weaker U.S. dollar as investors move capital out of safe haven cash and back into risk assets.
Right. And in the commodities market, materials are priced in dollars. When the dollar weakens, commodities effectively become cheaper for foreign buyers.
Which structurally boosts global demand and supports higher base prices.
Precisely. Add to that the potential for future interest rate cuts from the Federal Reserve. When the cost of borrowing money goes down, massive industrial and manufacturing projects become cheaper to finance.
That stimulates the entire industrial sector. leading to increased demand for raw materials and components like rare earth magnets. So you have lower operating costs, a favorable currency setup, and cheaper capital stimulating downstream demand.
It's basically a perfect storm for a heavy industrial manufacturer. And the professional analyst community is certainly interpreting the setup that way. The sentiment across Wall Street is overwhelmingly positive right now.
Yeah, there are currently 16 covering financial firms that assign a buy rating to MP Materials. The average 12-month price target among those analysts sits at $78.91.
To put that in perspective, we have major institutional research firms doubling down on our conviction despite the recent pullback. William Blair recently published a note reiterating their outperform rating.
And D.A. Davidson reiterated their buy rating while maintaining an $82 price target. They are actively viewing this 50% consolidation as a highly attractive entry point rather than a fundamental breakdown.
Exactly.
But let's shift our focus to the future, because understanding where a company has been only matters if we know what will drive the stock tomorrow. If an investor is looking at that $80 price target, what are the specific mechanical events that will actually force the market to reprice this stock upward?
Well, in the immediate short term, the market's eyes will be glued to the upcoming Q1 2026 earnings report. That's a big catalyst.
Right. Investors demand consistency. They need to see validation that the incredible margin expansion and cost control we saw in the Q4 beat wasn't just a one-time accounting anomaly.
Exactly. They will be dissecting the forward guidance to see how well management is navigating current pricing dynamics. However, the absolute crown jewel of the catalyst calendar, the event that will define the next 5 years for this company, is the execution and commissioning of the 2026 Texas magnet manufacturing plant.
This is where the rubber meets the road on the mine-to-magnet thesis.
Right. Building a factory is one thing. Consistently producing complex, high-grade magnetic alloys at commercial scale is a completely different challenge.
Yeah, the engineering tolerances required for electric vehicle motors and defense guidance systems leave zero room for error.
None whatsoever. The market is going to be hyper-focused on every update regarding the commissioning timeline, the yield rates of the manufacturing lines, and any new offtake agreements from major buyers.
The market is essentially pricing in a successful execution, which brings us to the most critical part of today's analysis, the bear case.
Yes, we absolutely have to acknowledge the risk profile here. MP Materials is not trading at a discount valuation.
No, it is not. The stock currently trades at a 20.48 forward price-to-sales multiple,
Which is incredibly steep for this sector.
Let's translate what a 20x forward sales multiple actually means for you listening. If you're buying a mature industrial mining company, you might expect to pay 2 or 3 times their annual revenue.
Right. Paying 20 times their projected revenue is a valuation multiple usually reserved for high-growth software companies with 90% gross margins.
Exactly. So the 20x sales multiple, are you essentially paying for perfect execution at the Texas plant? Like, how much room for error is there at these levels?
Honestly, not much. When you pay that much of a premium for a heavy manufacturing business, you are assuming the Texas plant comes online precisely on schedule, under budget, and immediately produces high-yield, commercial-grade magnets.
Any delay, any engineering hiccup, or any failure to secure buyers means the market will brutally reprice that assumption and the valuation could collapse.
The execution risk is definitely the primary vulnerability in this thesis. If they stumble during the commissioning phase of the Texas facility, the stock will face severe multiple compression.
And we cannot entirely dismiss the overarching threat of global commodity cycles either.
Exactly. If China decides to test the resilience of new Western competitors by aggressively flooding the market with cheap rare earths, it will inevitably put pressure on MP's revenue growth, despite their protections.
But this brings us full circle to the risk mitigation strategy we unpacked earlier. Yes, the 20x sales multiple demands flawless execution on the manufacturing side, but the catastrophic downside risk of a global price collapse is neutralized by that $110 per kilogram Pentagon price floor.
That's the beauty of it. You have a high-growth valuation sitting on top of a government-backed safety net.
Plus, considering the stock has already shed 50% of its value from the peak, you could argue that a significant portion of that execution risk has already been priced in by the market.
When we synthesize all of these moving parts, the geopolitical backdrop, the financials, the technicals, and the risks, the final analytical thesis yields an 8 out of 10 bullish score.
We're looking at a highly asymmetric opportunity here. The downside is structurally de-risked by the Department of Defense price floor and the massive non-dilutive cash infusions from partners like General Motors.
And the upside is driven by a fundamental transformation of their business model. They are evolving from a commodity extractor into a vertically integrated high-tech manufacturer.
Validated by blue-chip customers like GM and Apple, all while operating within a structural global supply deficit that shows no signs of easing.
Exactly.
So if you're considering this as an investment, what is the realistic time horizon? Because this doesn't sound like a quick swing trade based on the complexity of the manufacturing rollout.
No, not at all. This requires a multi-year hold horizon. The entire investment thesis is predicated on the slow, deliberate, and highly complex operationalization of the Texas facility.
Right, combined with the gradual decoupling of the United States supply chain from overseas monopolies.
Exactly. You are not buying a quarterly earnings play. You are buying into a multi-year geopolitical necessity. It requires patience to let the manufacturing capacity scale and to allow the long-term contracts to mature into consistent revenue streams.
It is a phenomenal intersection of free market mechanics and national security imperatives. And it leaves you with a much bigger question to ponder long after we wrap up today's analysis.
It really does.
If the United States government is willing to step in and artificially rewrite the rules of the free market, literally creating price floors and subsidizing factories just to secure rare earth metals for EVs and defense systems, what other critical overlooked materials might be next in line for this kind of market protection?
That is the million-dollar question.
Whether it's the graphite in our battery anodes or the specialized copper wiring in our grid infrastructure, it makes you look at the entire global supply chain in a totally different light, wondering where the next government-backed moat will be built.